My dividend growth portfolio wrapped up 2021 in great shape. Here's a bird's eye summary of the portfolio as we enter 2022. Across the top line, you can see that the value of the portfolio is $177,000, up 20.9% during the year of 2021. In the second column, I show the number of stocks, and now I've added 2 funds. So the number of stocks is 29, and 2 funds makes 31 positions altogether. That's up 4 positions, 2 stocks and 2 funds from the beginning of the year. The current yield is 3.1%. The annual income run rate is $5,421 a year as we speak. That's up 11% from what it was a year ago, January. The yield on cost has reached 11.6%. That's also up 11% since a year ago, January. The reason being that yield on cost and the income run rate run in tandem. The lines are the same shape, going up at the same rate. And finally, in 2021, I collected $5,197 in dividends. That's up 9.5% from what I collected in 2020. Other than the current yield at 3.1%, all of the other numbers on this display are new record highs for the portfolio. So that's why I say 2021 was a great year for this portfolio. The Dividend Growth Portfolio is a real-time, real money demonstration of dividend growth investing. It is not a backtest, it's not a model, it's not hypothetical, it's real. The DGP, which I call it, is set up to have 2 financial goals of the DGP is to build a reliable, steadily increasing stream of dividends over many years that can eventually be used as income for retirement. Obviously, this is a cash flow goal, not a wealth goal. The idea is not to build the most wealth possible. Rather, it is to build what I call a wall of income that will support retirement by being sufficient, reliable, and growing every year. This is my favorite graph for the whole portfolio. And the reason it's my favorite is because it shows how the portfolio has succeeded and continues to succeed in hitting its primary goal. You can see that each year that the portfolio has existed, it has increased its delivery of dividends from the prior year. The first full year of the portfolio was 2009, so I start counting there, and we've now finished 2021. And the average rate of growth has been 10.5% compound annual growth rate per year for that period of full years. Another way of looking at it is the dividends in the first full year, 2009, were $1,568, and the dividends in 2021 totaled $5,197, or more than 3 times 2009's total. This slide illustrates that I have never added more money to the portfolio myself since I began it in 2008. I contributed $46,783 to start the portfolio at the beginning of June 2008, and since then I have not put a single dime into the portfolio. And as we saw earlier, it's now worth $177,219, which is a growth, total growth, not per year, but total over the time span of 278% of gain. And all of that has come internally, so I call it organic growth. Many portfolios, of course, and probably many of your portfolios, you're adding money to it each week or each month, and all the growth statistics, of course, are influenced by that new money coming in. This one, because I wanted to illustrate dividend growth investing, the strategy, without the influence of new money, just seeing what the strategy itself can accomplish. That's why I chose not to add any new money to this portfolio ever since I started it more than 13 years ago. So that means that these results have come solely from the original stocks that I picked, the receipt and reinvestment of dividends over the last 13 and a half years, and portfolio management moves, examples of which would be the reinvestment of those dividends choosing new stocks to add to the portfolio, occasionally selling out of a position when its investing thesis is no longer working, or trimming oversized positions to keep some degree of diversification in the portfolio. The distinction between income and wealth objectives is important for 3 reasons. First, the income objective leads to a smoother ride. Dividends rarely go down, whereas prices go up and down all the time. This is a slide of Johnson & Johnson beginning in the year 2000 and continuing up till today. I love to use Johnson & Johnson to illustrate dividend growth investing principles because it has so many of them that are clearly visible. And I want to talk about a couple that show up on this slide. The purple line on the slide is Johnson & Johnson's price from 2000 to the end of 2021. And the orange, the stair-step line, is Johnson & Johnson's dividend over the same time frame. The scale on this is not actual dollars, it is percentage growth. That leads me to a couple things I want to say about Johnson & Johnson and that illustrate the point I'm trying to make about smoother ride. The price line, the purple line, as you can see, is jagged. It's extremely jagged even though 21 years are compressed onto this small space. You can still see the jags. I've circled 2 items on the price line. The first one during 2008 and 2009 is the Great Financial Crisis or the Great Recession of that period. Some of you weren't investing then, but I was. It looks like a small little blip on the slide now that everything's been compressed, but at the time it was a big deal. You probably know that it was the biggest market crash since the Great Depression. And then further along to the right, in early 2020, the quick dip down and back up that I circled, that's the market crash in 2020, the COVID crash that happened suddenly and then undid itself suddenly as COVID started to spread around the country and around the world. I put these things in to illustrate how prices are so jagged that, and if you watch prices, if you follow prices all the time on TV, you're going to be hit with a lot of instances where you might say, geez, I better sell some shares, or I better get rid of this stock because there's so much movement going on. I put the yellow highlight across the first 12 or so years of this slide because you can see that during that time, Johnson & Johnson's price was basically flat. You could buy a share of Johnson & Johnson in 2010, 2011 for the same price it would have cost you at the beginning of the century in 2000. That is the case even though Johnson & Johnson was increasing its earnings every year, its revenues practically every year. It was doing great as a company, but it was flat as a stock. And that went on for a decade. It's called the lost decade for Johnson & Johnson, and there are some other stocks that illustrate the same principle. And I can remember I was investing during those years, and I can remember that many people said Johnson & Johnson's dead money. It's a waste. You shouldn't put your money in there. And if all you looked at was price, you would probably believe that and see why they were saying it. But look at the orange line. The orange line, the stair-step line, that's Johnson & Johnson's dividend. And you can see that even though its price was flat for a decade, even though it went through the Great Recession and the Great Market Crash of 2008, 2009, and the COVID crash of 2020, each stair-step up indicates Johnson & Johnson raising its dividend. Johnson & Johnson has raised its dividend. I think now it's up around 50 years in a row. These are the last 22 of those years. Johnson & Johnson's dividend was being raised by company management in reaction to the fact that they were making more money every year. So the fact that they were making more money every year was not being reflected in the price in the market. The purple line doesn't show it, but the dividend shows it. And that's what I mean by smoother ride. If you're keeping your eye on the dividend rather than on the price, you're seeing a different story than if all you do is watch the price, watch CNBC, and listen to the talking heads, and that's basically all they talk about is the price. The second distinction between wealth building and income building is that the income objective influences the securities that you pick. So because I'm looking to fulfill an income objective rather than a price objective, I look for stocks of excellent companies that have good dividend track records. They're high quality companies with solid, durable dividends, and a record of increasing their dividends at least 5 years in a row. Those are the only stocks that I consider buying. I should mention here that one place you can find such companies is on a list. It's much more than a list, it's a spreadsheet called the Dividend Champions list. The Dividend Champions list has more than, I think, 600 stocks on it. But what I highlighted at the bottom is the criteria for being on that list. To be included on the list, a company must be consistently increasing its calendar year dividend payout for at least the past 5 years. That is my criteria for considering stocks for my dividend growth portfolio, and indeed for all the investing that my wife and I do. And I would urge you to Google Dividend Champions and go take a look at that list. It's free. It's an amazing piece of work. It has, 40, 50 columns of information on each stock, including its dividend information, but also fundamental information. It's a great research tool. The third advantage of investing for income over investing for sheer wealth is that portfolio management becomes much simpler. With dividends being far more reliable than prices, there are fewer temptations to sell when prices are falling. Even as we've already seen with the Johnson & Johnson graph, even though prices are going up and down all the time, with the best dividend income stocks, dividends are simply going up. They're either flat or up. In fact, when you adopt the dividend growth point of view, weak prices become a reason to buy because you can get higher yields and a better deal on the stock price when the price is sunk than when it's risen. I said there were two goals to the dividend growth portfolio, the primary goal being a reliable, steady, and increasing stream of dividends. The secondary goal is to have total returns that are somewhat competitive with the S&P 500. That goal was achieved until the market's recovery from the COVID crash in 2020. Since then, because of the rise of all the FANG stocks, the tech stocks, Tesla, Amazon, and so on, the S&P 500 has pulled away from the DGP's total return over the last year and a half, say. And I will say a little more about this near the end of this video. Since I don't add new money to the portfolio, how does the portfolio's dividend growth achieve that 10.5% growth rate that we saw on the earlier slide? This display shows the three reasons. Number one, companies declare dividend increases and issue the new dividends at the new amounts after each declaration. We can see with Johnson & Johnson, we saw with Johnson & Johnson, they've done that once a year regularly without ever missing a year for a very long time. Reason number two is that you reinvest the dividends, and I'm going to speak momentarily about my dividend reinvestment program for this portfolio. And reason number three is you adjust the portfolio from time to time. That means that you make trades, buy some things, sell some things to achieve whatever goals it is that you're trying to achieve. Item number one, the dividend increases. While I choose stocks that will do that I expect to do that, so the dividend increase, step one, happens kind of automatically. But steps 2 and 3, reinvesting dividends and making trades in the portfolio, those are on me. I am what amounts to the chief investment officer, the CIO, for this portfolio. So I make decisions like what to reinvest in, when to trim or sell a stock and put the money elsewhere, how many positions to own, and so on. Let's talk briefly about dividend reinvesting. I collect dividends and reinvest them monthly. I don't drip them. This display shows my dividend reinvestment activities in 2021. I'm not going to go through every item on the slide. You can see that I reinvested every month. I purchased some things every month. The column I want to draw your attention to is the fourth column over called annual income added. You can see that it's not much for each investment. It's usually around $15, $16, $17. But those little dribs and drabs add up over time. In 2021, I added $210 to my annual income run rate by making those monthly reinvestments. And if you look over to the bottom right, that added 4.3% to my portfolio's annual dividend run rate, doing nothing other than reinvesting the dividends that the companies were sending to me anyway. If you recall from the beginning, we saw this slide, and here I've circled two relevant columns to what we're talking about. The annual income run rate in the DGP in the year 2021 advanced 11%, and so did the yield on cost. And we just saw that 4.3% of that came from the reinvestment of dividends. Another way of noting the idea that reinvestments of dividends, while seemingly small and possibly seeming unimportant at the time you do them, add up and compound over the years, over the months, and over the years to where they become quite significant to the overall performance of the portfolio. In fact, over the life of this portfolio, which is now 13 and a half years, I've reinvested more than $42,000 in dividends. If you recall, I started the portfolio with about $47,000. So I've reached a point now where I've received and reinvested about 90% in dividends of the amount of money that I used to start the portfolio in the first place. As I practice it, dividend growth investing is mostly about collecting stocks without much trading or turnover, with most transactions every year being the dividend reinvestments that we just talked about. But as shown on this slide, I do make some trades. This slide summarizes the portfolio adjustments that I made in 2021. I've circled a couple to call to your attention, and you may recall these because they both happened since I began doing these videos. In July, I sold out of AT&T, which was a long-held holding for the portfolio, but the reason I sold it out was because they announced that they were going to reorganize, split off their media assets from their core telephone business. And in the course of doing that, from the numbers they put out, it became very clear that they will be cutting their dividends significantly in 2022 when they complete the spinoff. That meant that AT&T was no longer a dividend growth stock, and I decided to sell it at the time. In October, I sold out of Hasbro, another long holding of the portfolio, for a similar reason. Hasbro froze its dividend a couple of years ago, kept it frozen during COVID, and I thought when the COVID recovery started to come back and their own business results started to come back, they would reinstitute dividend increases, but they didn't, and I decided to get rid of Hasbro. Those are two examples of the kind of portfolio management decisions that you make as the chief investment officer of a portfolio like this. I draw your attention to the yellow highlights at the bottom of this display. The total cash value of the stocks that I trimmed or sold in 2021 was $18,413. And over in the right column at the bottom, the impact on dividends of making the trades that I made was to add just $59 to the annual income stream. Usually the trades I make during a year, trading out overvalued positions for better valued positions that have higher yields, results in more income increase during the year. But this year, it only resulted in a little, and that's because of the AT&T trade. If you look to that column opposite the AT&T trade, the first red circle, you see that trade out cost me $204 a year in annual income. I managed to make that up with other moves during the year. And of course, the portfolio, the dividend reinvestments that we've already seen made up for a lot more. But nevertheless, that was a hole that went into the portfolio. I still think the decision to sell AT&T at the time I did it was a good decision. I'm glad I did it, but it did give me a step back for a few months in my income run rate. The $18,000 turnover represents a churn rate of 11% for the year. That's high for this portfolio. There are some years when I make no trades at all and the turnover rate is 0%. But while it's high for this portfolio, it's not high in the world at large. For example, the largest dividend ETF in the world, Vanguard's Dividend Appreciation ETF, ticker symbol VIG, has a reported turnover rate of 25%. So 11% in a year is a lot for me, but it's not a lot in the world of investing. Over the life of the portfolio, the DGP's total gain is 279%, which is very good, I think, for an income-focused portfolio. But it does not match the total return of the S&P 500, represented by the ETF with the ticker symbol SPY, SPY, both of them with dividends reinvested. This display shows you that for the first 11 or so years of the DGP's life, I mostly ran ahead of SPY's total return. But in 2020, with the COVID crash and a quick recovery, you're probably all aware of the takeover of the S&P 500 by its top 10 or so holdings, all of which are the biggest tech stocks: Microsoft, Apple, Tesla, Amazon, which isn't a tech stock, but it's tech-enabled. Their prices have run up so much that those top 10 holdings in the S&P 500 now comprise, I think it's 27% of the whole index. So just 10 stocks out of 500 are responsible for 27% of the S&P 500's returns. And my portfolio has not kept up with that since COVID. On income, of course, it's the other way around in favor of the DGP. My portfolio has a current yield of 3.1% compared to S&P 500's yield of 1.2%. I will say in the last quarter of 2021, so-called value and defensive stocks, which are like most of the stocks that I own, began to reverse the year or two of tech stock domination. Whether that will continue into 2022 is something we don't know yet. We'll just have to see. Just for fun, I just looked. And today, as I record this, my portfolio is up 0.5% today, while the S&P 500 is down 0.33% today. So that's almost a 1% gain today. It'll be fun to watch and see whether that rotation, as they call it, from fast growth technology stocks into slower growth dividend type stocks continues. We just don't know yet. Okay, here's the portfolio as we enter 2022. While you look at this, I need to tell you that there is an error in E-Trade's information. That's what I'm showing you is a printout of an E-Trade display of my portfolio. When you get down to ticker symbol QYLD, E-Trade has miscalculated the annual income. They overstate it by a factor of more than 2. I have corrected that error in my numbers throughout this video. For example, at the bottom of the scroll, you'll see that they show an annual estimated income for the whole portfolio is $5,550. I corrected that to $5,421 because it makes a difference when you're calculating percentages, and it's simply a mistake on their part. I spent a couple hours on the day yesterday on the phone talking to E-Trade. They didn't seem to understand the problem or want to admit that they had one, but it is an error there. So I made those corrections. And as the scroll comes to a close, I will say that that's the end of this video. Thanks for watching, and goodbye, everybody. See you next time.